Welcome to our webinar, the final Tangible Property Repair Regulations and Fixed Asset Review, Opportunities for 2018 and Beyond. KBKG was established in 1999. We have offices across the U.S., including Illinois, Pennsylvania, Arizona, Georgia, Ohio, New York, Texas, and Pasadena, California, where our headquarters is located. We provide turnkey tax solutions to CPAs and businesses. Our engineers and tax experts have performed thousands of tax projects, resulting in hundreds of millions of dollars in benefits for our clients. Our team is a diverse mix of tax specialists, attorneys, and engineers from various disciplines. This combination of talent allows us to be the best at what we do and maximize results for our clients. KBKG is a preferred provider for thousands of CPAs across the country. I will now turn it over to our speaker, Eddie Price.
Well, hello, everybody. Welcome to our presentation today. I am coming to you from Bedford, Texas. I am right in the middle of the DFW Metroplex between Dallas and Fort Worth, close to DFW Airport, where it's sunny and 39 degrees outside. So it was in our 70s yesterday. It goes back and forth. No complaints. I know some of you out there are really cold, so I appreciate you joining us for these 2 hours of CPE talking about the tangible property regs. A little about my background. I'm a graduate of Texas A&M with an undergraduate degree in environmental design and a graduate degree in construction management. I joined KBKG a little over 5 years ago to lead our Texas-based operations. I also do quality control reviews on cost segregation studies and fixed asset studies, those done in Texas as well as other offices around the country. And I'm proud to say that KBKG is very involved in the American Society of Cost Segregation Professionals. It was one of the things that attracted me to come to work here because that organization is recognized as the primary professional organization in our industry. We currently have at KBKG 7 certified members of the ASCSP, including me. I currently serve on its board of directors, its testing committee, and I've been a past chair of the education committee. All of the cost segregation reports that I review here at KBKG are signed and certified with my seal, my ASCSP stamp, which is a symbol of quality to anyone else who might have reason to review that report. In particular, the IRS would recognize that. I'm in my 35th year in the cost segregation industry, and 20 of those were with the Big Four CPA firm. Well, at the end of our presentation today on the tangible property regulations, we will have covered all the bullets that you see displayed here. Most of what I'll cover will be presented from the standpoint of a taxpayer that owns a building or leasehold improvements. We'll start out by reviewing the impact of tax reform on bonus depreciation, 179 expensing, and net operating losses. Then we'll talk about the unit of property and the 8 building systems that must be identified according to the regs. We'll go over the definition of an improvement, and we'll step through the bar test. We'll spend time talking through how the regs apply to the evaluation of certain types of building components. We'll specifically look at HVAC and roofing examples, and we'll demonstrate why it's important to recognize retirements. We'll show you how you can determine the remaining depreciable basis in a building component that's been retired. And though not directly related to buildings, we'll talk about the rules related to materials and supplies. We'll look at the routine maintenance safe harbor and see how it applies to buildings. We'll also talk about the safe harbor for small taxpayers and the de minimis rule. And finally, we'll wrap up with an overview of the retail restaurant industry safe harbor. Well, beginning after September 27th of 2017, the 100% bonus depreciation rate is applicable, and that's all the way through 2022. And then it's scheduled to drop by 20% each year after that. The bonus rates can be extended an additional year for long production period property and for non-commercial aircraft. To qualify as long production period property, an asset must have a recovery period of at least 10 years and be subject to Section 263A of the Internal Revenue Code. It must have an estimated production period exceeding 1 year and production cost exceeding $1 million, and it must have been acquired subject to a written contract entered into prior to January 1st of 2028. This will become more interesting when we get up towards 2022 and into that transition period. For now, that's probably not the most exciting information. The new law no longer requires that the original use of the property, of the qualified property, begin with the taxpayer, as long as the taxpayer had not previously used the acquired property and the property was not acquired from a related party. Now that is exciting news. The opportunity to take bonus depreciation on acquired property is a very significant benefit that taxpayers have never had before. During my career, I've seen bonus depreciation come onto the scene at 30% rate. I've seen it go up to 50%, to 100%. I've seen it go away and come back, but we've never seen it for used property before like this. So that's a very good thing for taxpayers. The proposed regulation section 168K2 was issued on August 8th of 2018 and applies to property acquired and placed in service after September 27th of 2017. The 60-day comment period has expired, but the regs themselves have not been finalized, so taxpayers can rely on the regs, but they're not required to yet. To be eligible for bonus depreciation, property must be of a specified type, the original use of it must commence with the taxpayer, or if used property must meet certain acquisition requirements. It must be placed in service by the taxpayer within a specified time period and must be acquired by the taxpayer after September 27th of 17. For property that was acquired and placed in service prior to 9/28 of 17, the old section 168K1 generally remains applicable. Now, I mentioned earlier that bonus eligible property must be of a specified type. This would include maker's property with a recovery period of 20 years or less. It would include certain computer software and water utility property. It also includes a couple of new categories: qualified film or television production property and qualified live theatrical production property. Sadly, however, several types of 15-year recovery property were removed post 12/31 of 2017. These would include qualified leasehold improvements, qualified restaurant property, and qualified retail property. Qualified improvement property still exists under the current tax law, and it's defined as an improvement that is made to the interior of a building after the original building was placed in service. It can't be an elevator or an escalator. It can't be an expansion, and it has to be non-structural in nature. So even though this qualified improvement property, or QIP, still exists, it no longer has the favorable bonus treatment it had in the prior law. QIP came onto the scene due to the PATH Act of 2015. So effectively, it came into existence and into use by taxpayers in 2016 and 2017. And at that time, it was 39-year property, but it specifically was eligible for bonus depreciation, and so it had the 50% bonus. The Tax Cuts and Jobs Act removed it from the list of property of a specified type. It was on that list before. And then, after removing it from the list of property of a specified type, it failed to add language clarifying the intended recovery period change of 15 years. So now, stripping it away from property of a specified type and not providing it a recovery period that would cause it to be eligible for bonus, QIP remains 39-year property, but now it's no longer bonus eligible post December 31st of 2017. The proposed regs do confirm that qualified improvement property that was acquired after 9/27 of 17 and placed in service before January 1st of 2018 is eligible for the 100% bonus depreciation, even though it's recovered over 39 years. So amazingly, you could have the same facts and circumstances about the type of property and just change the dates. And if you had your qualified improvement property placed in service, say on September 1st of 2017, it would be 39-year property 50% bonus depreciation. If it was placed in service on November 1st of 2017, it would be 39-year property, 100% bonus depreciation. And if it was placed in service on February 1st of 2018, still 39-year property, and now 0 bonus depreciation. Quite a swing in just a few months. Based on the proposed regs, the acquisition requirements of the effective date are addressed under Section 13201H of the Act. The result here is there are 3 basic types of projects. For existing acquired properties, the date the taxpayer enters into a written binding contract is the key for determining the applicable bonus rate. The regulations clarify that a letter of intent is not the same as a binding contract. For tax purposes, a written binding contract is going to be a contract that's enforceable under state law, where liquidated damage provisions can be 5% or more of the contract price. So if you think about it, real estate contracts that typically only limit damages to earnest money, that is usually less than 5% of the contract price, are generally not going to meet the definition of a written binding contract. However, KBKG always recommends to taxpayers that they consult with an attorney regarding the binding nature of the contract in these situations where they're right on the bubble, of qualifying or not because of that written binding contract date. For new construction property that's manufactured, constructed, or produced for the taxpayer by a third party under a written binding contract, the property is treated as if it were acquired pursuant to a written binding contract, just like existing acquired property. So the rules are the same as we just discussed. But for self-constructed property that is constructed by the taxpayer for its own use, the property is not considered acquired until the taxpayer begins manufacturing, constructing, or producing the property. So in this case, an optional safe harbor allows the taxpayer to determine the effective acquisition date as the date when 10% of the total construction cost has been incurred or physical work of a significant nature has begun. I would like to take you through some examples of how bonus depreciation is affected here. First of all, the one you see there, that suppose a taxpayer enters into an agreement here to purchase equipment on August 1st of 2017 with a 25% penalty for restocking if the contract is canceled. If the equipment's delivered and installed on October 1st of 2017, it will be eligible for 50% bonus treatment. Even though the placed in service date was post 9/27, the taxpayer had a binding contract in place prior to 9/28, so the old law applies. Scenario number 2, suppose the taxpayer begins construction on new interior improvements using a general contractor on October 1st of 2017. The work is completed and placed in service on January 15th of 2018. So in this case, the property is eligible for 100% bonus treatment because both the placed in service date and the acquisition date are post 9/27/17. Situation number 3. Let's consider a taxpayer here who signs a letter of intent to acquire a freestanding restaurant on June 1st of 2017. But the acquisition doesn't actually occur until November 1st of 2017, after which the taxpayer promptly opens for business. And in this case, the place of service date we see and the acquisition date they're both post September 27th, 17, and prior to January 1st of 18, which creates the very unique situation of allowing the entire structure to be considered qualified restaurant property. And so now the whole thing, it's either 5 or 15-year property, so the whole thing is treated as 100% bonus depreciation eligible. Very unique situation because of those dates that it was in service and when it was acquired. Situation number 4, last we have a taxpayer that begins construction on its own property on September 1st of 2017, but as of October 1st of 2017, only 8% of the total cost of the project has been incurred. Ultimately, it's completed and placed in service on May 15th of 2018. So here you have self-constructed property, and less than 10% of the self-construction was completed by September 27th of 17. So it's considered acquired after 9/27, and in this case, the bonus eligible property is going to receive the 100% bonus rate. Section 179 allows businesses to deduct the cost of purchasing qualified equipment and software. And for 2018, the deduction limit was increased to $1 million. The 2018 spending cap is up to $2.5 million, which means there's a dollar for dollar reduction in the limit for every dollar spent in excess of $2.5 million. So if the taxpayer spends $3.5 million on 179 eligible property, then they would effectively eliminate their capacity to use the 179 expense. The Tax Cuts and Jobs Act permits 179 expensing for roofs, HVAC, fire protection, and alarm systems, and security systems. This is new and different, and it's unique. It's only applicable to commercial buildings. It's not for residential, and it's limited to improvements made after the building was first placed in service. So if you're talking about a new construction project, you can't carve these items out. But if you're talking about improvements made to an existing property, you potentially have these to identify and consider. So here's an example. Suppose a client purchased an existing 10-year-old building in 2018 for $4 million. Before placing it in service, they put in a new roof, a new HVAC system, fire protection, and security system, all for $500,000. All of that is 179 eligible. You might be thinking, how can this be true since the improvements were done before the taxpayer placed the building in service? The key here is the building itself was originally placed in service 10 years ago by some other taxpayer, so the first placed in service requirement I mentioned was actually satisfied. $179 expensing now includes personal property that's used for furnishing lodging, such as furniture and appliances in hotels, apartment buildings, and student housing. This wasn't the case in the past. These categories were excluded. So now that's expanded for those taxpayers. Something to consider here is that there's no real benefit to taking the 179 expense on tangible personal property that's already eligible for 100% bonus depreciation. So taxpayers maybe should consider utilizing the 179 expensing on these items that are otherwise not eligible for bonus depreciation, such as roofs and HVAC equipment. Those are optional. That they can elect to take the 179 expense on those items, but why not take it on those instead of these others that you're already getting a full deduction in the current year because of 100% bonus depreciation. Do note that taking the 179 expense does make them subject to recapture. Tax reform has made some major changes to the utilization of net operating losses. The carryover and carryback rules changed, and a new limitation on net operating loss utilization has been added. Under the prior law, you'll probably recall, net operating losses were generally eligible for a 2-year carryback and a 20-year carry forward. And net operating loss carryovers and carrybacks could fully offset the taxable income of a taxpayer if not otherwise limited under the code. Well, both of those rules have now changed. The current law disallows NOL carrybacks altogether. You can no longer go back with them, but it allows the indefinite carry forward of those NOLs. But in any given tax year, the NOL deduction cannot exceed 80% of a taxpayer's pre-NOL deduction taxable income. These limitations on the use of the NOL deductions only apply to NOLs generated after 2017 So this provided another motivation to maximize those deductions associated with the 2017 tax returns at the time. Okay, so we're going to dig on into the details of the tangible property regs for the balance here. These regs are effective for all taxpayers other than small qualifying taxpayers for tax years beginning on or after January 1st of 2014. And we're referring here to the regs that were issued in their final form back in September of 2013. And the regs were previously issued in temporary form in 2011. So at that time, we'd had several years to adjust and prepare for the changes that were coming. Some of the more capital-intensive taxpayers were early adopters that chose to take advantage of the tax-favorable characteristics of the regs. And in the years leading up to the final regs, there were a number of instructors out there suggesting that everybody needed to be filing 3115s, which turned out to be not necessarily the case. The final regs provided rules for distinguishing between a currently deductible repair and a capitalizable expenditure. Prior to the regs, a controller might look at an invoice, say for $30,000, and assume, wow, that's a big cost. Therefore, it needs to be capitalized. And they would capitalize and depreciate it as an asset over the years. Well, these regs provided some guidelines around that and offer up lots and lots of examples to help us understand how to navigate those rules. They sort of create general boundaries and guidelines within which you can make some general assumptions about how to consider such expenditures. Yes, they were adopted with a change in accounting method using Form 3115, oftentimes with a very favorable 481A adjustment calculation. Change number 184 is one of the most common changes that allowed you to take an item that had been previously depreciated and make it a current year expense by taking the remaining depreciable basis as an expense in the year of change. Well, let's go ahead and address an expectation some of you out there may have about the determination of a repair versus capitalization. You may have come into this webinar expecting there to be kind of a black and white answer to that determination. Well, instead, like many other areas of the tax law, there are no bright line tests. It's very much dependent on the facts and circumstances surrounding an expenditure. The regs describe the concept of a unit of property. Now, to properly evaluate our facts and circumstances relating to an expenditure, we really need to understand how the unit of property is affected. The expenditure must be evaluated in the context of the unit of property. Let's look at some examples. If we spend $30,000 for 5 new plumbing fixtures, where the unit of property is the plumbing system in a small 5,000 square foot building, we might assume that this is a capital expenditure because the $30,000 is likely a significant cost relative to the plumbing system in a small building. However, the same $30,000 of expenditure for 5 new plumbing fixtures, where the unit of property is the plumbing system in a large 50,000 square foot building, in that case, we're more likely to conclude this is a repair expense, as this would likely represent a very small portion of the total plumbing system. You see that in our examples. The same items replaced require different treatment because of the facts and circumstances and how they relate to the unit of property. And as you think about the unit of property, one principle that you should begin to understand is that the smaller your unit of property, the more likely it is that your expenditure will need to be capitalized. And conversely, the larger the unit of property, the less likely that you'll need to capitalize that expenditure. Let's take a closer look at this term, unit of property. If you think about it, an asset can have many component parts. However, a single unit of property will consist of a group of components, all of which are functionally interdependent. For a unit of property to function correctly, it really needs to have all of its component parts in place. Another way of evaluating functional interdependence is to observe when the components are placed in service. If you would only place one component in service in conjunction with the other components, then you might conclude they are all functionally interdependent. There are special rules for different types of property. For plant property, the unit of property is further broken down into each component or group of components that performs a discrete and major function or operation in an industrial process within the functionally interdependent machinery equipment. For network assets, which would be like railroad track, oil and gas pipelines, and so on, your particular facts and circumstances or industry guidance from the Treasury Department and the IRS are going to determine what the unit of property is. In this webinar, kind of going forward through our slides, we're going to focus most of our attention on buildings and leasehold improvements, which covers probably 85% of the taxpayers' questions out there. In the context of a building, the entire building and its structural components together constitute the single unit of property. So the whole building is one unit of property, but notice that a building structure consists of a building and its structural components other than the structural components designated as building systems, and there's 8 of those. So these 8 building systems have been identified for us in the regs, and we're expected to break these out in a building for use down the road when you start disposing of assets. So these include HVAC systems, plumbing, electrical, elevators, escalators, fire protection and alarm, security systems, and gas distribution systems. And then we have number 9 here, which is just a catch-all for all the rest of the components of the building. Everything else is just considered part of the building structure. Well, any quality cost segregation study is going to break out these systems for the taxpayer. In our example earlier about replacing plumbing fixtures, we compared the replacements to the entire plumbing system when determining whether it was a repair expense or whether it should be capitalized. That's an example of why it's important to have these systems broken out within the total building cost. It doesn't help you perhaps in the tax year where you have the breakout done. It helps you down the road in future years as you start incurring costs to maintain the building. And how you evaluate those costs is you're going to compare them to some of these systems. For leased buildings, the unit of property is viewed differently depending on whether you're the lessor or the lessee. So if you're the lessor, the entire building constitutes the unit of property, just like we were discussing on the previous slide. The lessor in this case needs to consider the basic building systems serving the entire building and evaluate modifications to those systems in that context. Context is the key. For the lessee, the unit of property is limited to that portion of the building subject to their lease. And any future improvements made to the lessee space are combined into the existing unit of property under lease. The building systems must still be considered, however, but only that portion that is within their lease space. The plumbing system in the lessee space might be limited to a break room or kitchen sinks. Perhaps they also have a dedicated restroom with associated plumbing fixtures that they're responsible for. So in our example, a lessee in a large building remodels the dedicated restroom located in the tenant space. If the lessee performs the work, it's likely going to be a capital improvement because work was done on a major portion of the plumbing system located within their space. Let's say the lessee occupies one floor of a 5-story building. If the same work were instead performed by the lessor, it might be treated as a repair expense, as it's only affecting a small amount of the entire building's plumbing system. So again, context is the key. Let's talk about the depreciation consistency rule. It's very common to have multiple asset classifications with different recovery periods within the same building. We've discussed that the building is a single unit of property and may have multiple building systems. But these systems within the building can have multiple asset classifications and recovery periods. If a component of a building is a separate class of property, then it's treated as a separate unit of property as well. So when we perform a cost segregation study on a building, we're typically identifying 5, 7, and 15-year MACRS property associated with that building. Those items that we've segregated into different recovery periods are no longer part of the building unit of property. They're considered separately. So going back to our example of a cost segregation study done in a hotel where a portion of the electrical system is segregated into an asset class, class 57.0 with 5-year recovery, and asset class 00.3 with 15-year recovery. The 5-year property includes some decorative chandeliers and wall sconces. The 15-year property includes some outdoor parking lot lighting. Any future expenditure to replace decorative lighting needs to be compared to the 5-year lighting system cost when evaluating it as a repair versus capital cost. It wouldn't be appropriate to compare the entire lighting system of the building, including the 39-year basic building lighting. The depreciation consistency rule reinforces my comment about the importance of breaking out and summarizing the units of property included within the building. According to the tangible property regs, an improvement is any amount paid for that either 1, results in a betterment to the unit of property, or 2, adapts the unit of property to a new or different use, or 3, restores the unit of property. If any of these criteria are satisfied, the asset is an improvement and must be capitalized. This is commonly referred to as the bar test. Notice that each test is in reference to the unit of property. Most work performed on a building is done to make it better to some degree, but does that mean it's a capital improvement? No, not necessarily. We'll look at that further on the next slide. If we adapt a warehouse to showroom space or convert a restaurant to retail space, we've changed the use of the property, and the cost of conversion needs to be capitalized. We'll look at this on another slide. Finally, we also look at several examples from the regs about what's considered to be a restoration of the unit of property. A betterment is something that corrects a material condition or defect. A betterment is a material addition, which could be an enlargement, an expansion, or an extension. For example, if you lease a 10,000 square foot building and add on a 2,000 square foot warehouse addition, you'd have a betterment. A betterment would also be a material increase in the capacity, productivity, efficiency, strength, quality, or output of the item. So for example, if you replace asphalt shingles with new solar shingles, you have a betterment. However, it might not be so easy to determine when comparing one asphalt shingle to another type of asphalt shingle. One thing to keep in mind is that technology is always improving, and sometimes it may actually be difficult to replace a component with one that's truly comparable. Actually, that's probably often the case. For example, if you're replacing your 20-year-old HVAC unit in a residential rental property, I'm pretty confident that the low-end SEER rating available to you today will be better than whatever the rating was on your 20-year-old unit. In situations like that, the new unit isn't necessarily a betterment. If you're replacing a builder-grade quality unit today with one from 20 years ago, replacing the one from 20 years ago with a builder-grade quality today, and it's builder's grade replacing builder's grade, then it would seem unlikely that you would have a betterment. Now, although we're focusing on material change, I've been emphasizing that word on this slide, the IRS has not defined what that means. So it still comes back to facts and circumstances, comparing your facts to those of the examples provided in the regs. Let's walk through some betterment examples. In the regs, An example is given of asbestos removal not being considered a betterment. At first blush, I was surprised to see that, but if you think about it, asbestos does not have to be removed. It's not dangerous merely because it's there. It can be contained, and so its presence doesn't demand removal, and removing it doesn't make the building better. It's not considered a defect that has to be improved. In another example from the regs, a taxpayer purchased an assisted living facility that needed work done at the time of purchase. In this example, the taxpayer took possession of and operated the facility and also immediately began to perform extensive repairs to bring the facility up to a higher quality condition. The taxpayer here might be inclined to think that because the facility was operational the entire time that the work was done, that it wouldn't be considered a betterment. The service would likely say the taxpayer bought the facility at a discount because it needed work. Therefore, these extensive repairs are just ameliorating or correcting a pre-existing condition and therefore should be capitalized. If you were to reconfigure office space by adding more cubicles and spending $30,000 on 50 more electrical outlets and video data jacks, you're adding new assets here, and likely this is a betterment. However, you should consider how significant this cost is compared to the overall electrical power system in making that determination. Another roof shingle example is wood shingles. In most parts of the country, they're no longer available, or else they're not permitted for replacements. The new asphalt shingles are stronger and safer, but they're not considered a betterment due to the way technology in this area has just evolved. If instead of standard asphalt shingles, you chose to go with lightweight composite shingles that are maintenance-free and have a 50-year warranty and a Class A fire rating, you're now looking at a potential betterment. If we incur costs to adapt something to a new use, then we must capitalize those costs as an improvement. In our example here, the taxpayer is converting a manufacturing building into a showroom for its own business purposes. The scope of work seems pretty typical of the kinds of things you might think of as a repair expense under other circumstances, but this change of use is what's triggering the need to capitalize this work as an improvement. If they replaced lights, painted the walls, and replaced the components as part of their manufacturing operation, those same types of items under those circumstances might actually qualify as a repair expense, assuming all other requirements are met. All right, so what is a restoration? In order to have a restoration, one of the following events have to occur. A restoration could be an amount paid for a replacement of a major component or a substantial structural part of a unit of property. Again, one of these bullets have to have occurred for restoration. It could be an amount paid to return the unit of property to its ordinary operating condition if the property is deteriorated into a state of disrepair and it's no longer functional for its intended use. It could be for an amount paid to rebuild the unit of property to a like new condition after the end of its class life, which is basically the same as its ADS recovery period. It could be a restoration for the replacement of a component of a unit of property for which the taxpayer has properly deducted a loss other than a casualty loss, or taking into account the adjusted basis in realizing gain or loss resulting from a sale or exchange of the component. And finally, a restoration could also be the amount paid for the restoration of damage to a unit of property for which the taxpayer is required to take a basis adjustment as a result of casualty loss or relating to a casualty event. In our previous slide, we referred to a major component of a unit of property. A major component would be one that performs a discrete and critical function in operating a unit of property. Examples here might include the lighting system, air conditioning, flooring, other things. A substantial structural part is a part or a combination of parts that comprises a large portion of the physical structure of the unit of property. In the context of a building, which again, most of our presentation is focusing on, an amount is for the replacement of a major component or a substantial structural part if the replacement includes a part or a combination of parts that comprises a major component or a significant portion of a major component of the building structure or any system. It's a lot of words there, folks. The same would be true if the replacement includes a part or combination of parts that comprises a large portion of the physical structure of the building or any system. So for example, if more than 50% of the lighting in a building is replaced, a restoration has occurred. Although the final regs don't provide a bright line test for determining whether replacement of a major component or substantial structural part is a restoration, the examples tend to suggest that the IRS doesn't consider the replacement of a third or less of a unit of property to be a replacement. Again, these examples are intended to be like guidelines, guardrails to kind of keep you within the boundaries of the intentions of the regs. An incidental component generally will not constitute a major component, even though it may perform a discrete and critical function. Think here of your thermostat in a residential rental property. It really does perform a discrete and critical function for the whole HVAC system, but it's a very, very minor component. It's inexpensive to replace, and the average person can do it themselves. Very little effort involved, so it would not be considered a capitalized cost. In the final regs, the restoration standards must be applied to all major components of the building or unit of property. So step one here is to identify the major components within the building system. Step two is to determine whether a significant portion of a major component was replaced. In the example you see here on the slide, we describe an office building, the HVAC system of an office building, where there are 3 furnaces, 3 AC units, and the associated ductwork throughout the building. Now, if one of those furnaces breaks down and is replaced with a new furnace, has a restoration occurred? The furnace can be a very expensive item, especially in a more complex building, but here, the 3 furnaces together are performing the critical function of serving the HVAC system, and together would comprise a major component. However, replacing only one of those 3 is not considered by the IRS to be a significant portion of the major component. Therefore, it passes the restoration test, and assuming all other tests are satisfied, this could be a current year repair expense. Let's take a look at another restoration example. If we replace the chiller in our building, and it's the only chiller in the HVAC system, then essentially we've replaced a major component that's performing a discrete and critical function because the system's inoperable without the chiller. Notice that we replaced the chiller here with a comparable unit, so we don't have an issue with the betterment test, but we fail the restoration test, and so we end up having to capitalize the new chiller. Now, on the other hand, assuming the same facts, except that the replaced chiller were one of 4 chillers in the HVAC system, which in some office buildings actually are like that. In that case, if it's just one chiller replaced, we might consider it a minor component and treat the chiller cost, in that case, as a repair expense. And believe me, chillers can be very, very expensive, but in that case, could fit the requirements. Here's another HVAC example. We have 10 rooftop units serving the various zones in our building. Due to climate control problems in some offices, we decided to replace 3 of those units. It's obvious that 10 units would comprise a major component of the HVAC system. However, the 3 units, as we were discussing before, are only 30% of the whole system, so not a significant portion of the major component. So the 3 units are also not a substantial structural part of the HVAC system, and therefore the replacement's not a restoration, and assuming it's not a betterment, the expenditure can, in this case, be deducted as a repair expense. Some of you might be wondering about the new provision under the Tax Cuts and Jobs Act for treating such items as an expense under Section 179 and whether it would apply here. And the answer is yes, it absolutely would apply. So that's another option to consider. Even if you've replaced all 10 units, you could still potentially take the 179 expense deduction if you have eligibility. Let's say you've already hit the cap on 179 expense, and so that's no longer an option. In that scenario, you can still deduct the cost of the 3 units as a repair expense. Just because it fails the one test doesn't mean it won't pass a different test. Here's a couple of pictures to show you how this looks in the real world. In the left picture, we see 5 roof-mounted HVAC units, and in the right picture, there are 4 ground-mounted HVAC units. In situations like these, it's really easy to figure out whether you've replaced a significant portion of a major part of the HVAC system. However, it gets somewhat more challenging in a larger or more complex building where the HVAC components tend to be concealed inside the ceilings or in mechanical rooms that are scattered throughout the building. Without a good understanding of the layout of the building, without good drawings, or without a building engineer to help you figure it out, it's just more difficult to know. Okay, here's a couple of simple examples of applying the regs to roofing work. In our first example, X replaces 60% of the roof decking, the insulation, and the roof membrane. X replaced a major portion of the roof system, so this is a restoration, and therefore it must be capitalized. In the second example, Y replaces only the outer roof membrane and does so with a comparable product, so it's not a betterment. The roof membrane alone, even though it affects the function of the building, and even if it's 100% of the total membrane, is considered to be only a minor portion of the total roof system. Therefore, since it's not a restoration and it's not a betterment, it can be deducted as a repair expense. I think this surprised a lot of folks, but this is an example straight out of the regs. In my experience, a high percentage of invoices for roof repairs can potentially be treated as a current year repair expense. The key to evaluating those invoices is to ask insightful questions and assemble your facts and circumstances so you can evaluate the nature of the work performed. That's what we're going to talk about for a few slides. A common building component that gets a lot of attention with respect to repairs is the roof. And KBKG has an article out there we wrote on expensing roof costs, and it was published in the Tax Advisor last year. And I think you might find it helpful. It's referenced here on this slide. The link to it is on this slide. And the same restoration analysis that we discussed with HVAC components applies to the roof system. The roof system falls into that 9th category of the building structure, apart from the 8 defined building systems. In order for us to assess whether a substantial structural part or a major component has been replaced, it's helpful to take a step back and understand the basic components found in a roofing system. Now, I realize most of the folks that are attending this webinar are not roofing contractors or really contractors of any sort. Most folks are tax professionals to some degree and maybe taxpayers that have responsibility for a building. So we want to walk you through understanding some of these components that you see in such invoices. Most common roof systems fall into one of 2 major types. The first type is a steep pitch roof assembly, and it's most commonly found in residential rental properties. Probably many of you live in a house that have a roof that's shaped like this, pitched roof with an attic, and the component parts of this assembly include 3 primary parts. The first is the underlying roof deck, which in our picture looks like a wood deck supported by wood rafters. And the next layer is the underlayment, which provides a weatherproofing barrier and is sometimes referred to as felt or paper. The last layer is the roof covering, which can include various types of shingles, clay tile, concrete tile, slate, wood shakes, or even metal roof systems, and probably a variety of other things. Low pitch roofing systems, on the other hand, are more commonly found in commercial buildings and consist of three sections. The first layer is the roof decking, and in this case, it's typically a corrugated metal panel supported by structural beams. However, sometimes, depending on what part of the country you're in, that roof deck may be wood, and the beams that's supporting it may be in wood. On the West Coast, I tend to see a lot of wood frame structures, and as you move toward the east, you see more of the steel and metal structures. The next layer is an optional insulation layer. Unlike the steep pitch roofing where the insulation is below the deck in an attic space, you know, when you're in the attic, you're kind of walking around the insulation. The final layer here on this low pitch roof is the roof cover or membrane. So instead of having insulation on the inside underneath the deck, you have it on top of the deck, but below the roof membrane. Some of the common types of roof covers used include built-up membranes, metal panel roof systems, modified bitumen sheet membranes, synthetic rubber membranes, thermoplastic membranes, and spray polyurethane foam-based roof systems. A lot of words there. You know, really, you'll see a lot of those kind of words on invoices, basically. That's why I listed those off. But varieties of flat roofs are what you see on the low pitch flat roofing. So once you understand the components and kind of understand what they're talking about on the invoices, how these are built, how they work together, you're somewhat prepared to ask intelligent questions to the taxpayer or to the contractor, whichever the case may be. And so now you want to apply the tangible property regs to your understanding of the scope of what was done. So the questions on this slide will help you discover the relevant facts. Why did the roof need to be replaced? If it was because of a casualty event and the taxpayer properly deducts a casualty loss by reducing the building's basis by the amount of the loss, the cost of the new roof has to be capitalized. If the building's basis was less than the casualty loss, the excess portion is capitalized only if it meets all the other criteria for an improvement. How much of the roof layer was replaced? If only the outer roof covering, the membrane shingles and such, was replaced, but none of the underlying roof system, then it's not a restoration. If any load-bearing structural elements, including the decking and sheathing, were replaced that supported more than 40% of the roof, in that case, the entire cost is likely a restoration. If more than 40% of the insulation layer between the roof covering and the structural elements were replaced, it may be a restoration. It's kind of in the fuzzy middle there. Was the roof work part of a project to return the building structure to its ordinary operating condition after it had been deteriorated to a state of disrepair and no longer functional for its intended use? You see, most building structures can continue to function as intended with some degree of roof problems. So you might have minor leaks, you might have some exterior trim damage, but at some point, the disrepair of a roof grows. It becomes significant enough to impede the normal functions of the building structure, and the cost of the roof work has to be capitalized as a restoration. Did the taxpayer claim a retirement loss or a partial disposition deduction for any portion of the old roof? If so, the cost of the roof work is capitalized as a restoration. How much time elapsed between the building acquisition and the roof work? Generally, if the roof work needs to be done soon after the building was acquired, say 2 years later, it might fall into the betterment category because the work corrected a material defect or condition that existed before the building was acquired. However, if a long period of time has passed since the original building acquisition, say 7 years, it generally doesn't fall into that category. What kind of roofing was there before, and what kind was it replaced with? If improved materials were used, what was the expected life of the old roof and what's the expected life of the new roof? Going from asphalt shingles with a 20-year life to clay tile with a 50-year life is a betterment, because that would materially increase the capacity, efficiency, or quality of the building structure. Were improved roof materials used because comparable materials were no longer available or technologies advanced? If it's not practical to use the old type of roofing system, it is generally not a betterment. And if the old roof materials performed worse than industry standard roofing material for that location and building type, it is generally not a betterment under this test. Did the roof work relate to a physical enlargement of a building? If so, the enlargement portion of the roof is capitalized, and depending on the facts, possibly the entire roof replacement. In this last slide of restorations, I'm showing you related restoration examples that focus on paving. In this picture, the left picture, you see the application of a slurry coat seal. The asphalt isn't actually being replaced, it's just receiving a protective coating, which will slow the deterioration of the paving. In the right side, you see asphalt, which is cracked, and now the cracks have been repaired. Both of these procedures are normal maintenance that's expected and recommended to preserve the character of asphalt paving. Both would pass the betterment and restoration test and be considered deductible as current year repair expenses. So to this point in this presentation, we've talked about tax reform and repair versus capitalization. Now we're going to shift gears a bit and focus our attention briefly on retirements and dispositions, and then we'll move on to other relevant topics. The final disposition regulations were issued in August of 2014, and almost a year after the tangible property regulations were finalized. The current rules allow the taxpayer to take a loss deduction when they remove anything from a building. So, for example, if you pay $50,000 to replace all the HVAC units in your building with new ones, you need to capitalize that amount. The $50,000 is then recovered over 39 years, and you do have an opportunity here, though, to figure out how much remaining basis is left in the old HVAC units and claim that amount as an immediate deduction in the tax year this occurs. This is considered a partial disposition, and it can only be done on a go-forward basis in conjunction with a timely filed tax return. When the regs first came out in final form, there was an opportunity to retroactively take advantage of this for late partial dispositions from prior tax years. That retroactive opportunity has since expired, so if a taxpayer fails to take advantage of a partial disposition in conjunction with a current tax return, then they forego the opportunity to recognize the partial disposition. If you acquire an existing building and don't know how to calculate the remaining basis in a component of the building, you might want to take advantage of our partial disposition calculator at the link that we've posted here on this slide. We created this tool for that situation, and it relies on the producer price index in conjunction with other factors to help you estimate the remaining basis. And we'll talk more about how the calculator works in a later slide. Let's talk about an example here to see the impact this can have. Suppose the taxpayer acquired a building in 2010 for $5 million, and then later in 2017, they spent $1 million to remodel a part of the second floor. So the ceilings, walls, lighting, plumbing, ducting, electrical wiring. Now, suppose KBKG analyzes that original cost of the demolished components and discovers that they represent $470,000 of the original $5 million building basis. So out of what they originally spent, of that $5 million in 2010, $470,000 was associated with these demolished components. The result is the taxpayer can now recognize a loss of $404,000 in the 2017 tax year. So that's the original cost basis, the $470,000, less depreciation that's already effectively been taken. That means we got $404,000 left in undepreciated basis. So remember, as said on the previous slide, you can only take advantage of this partial disposition in conjunction with a timely filed return. Otherwise, you forego this opportunity forever to recognize that retirement. The reason that retirements are significant is that they result in permanent tax savings. If you incorrectly continue to depreciate Section 1245 and Section 1250 property that was removed from a building, eventually you're going to pay recapture tax on the sale of the property. Now we say incorrectly here because the retirement rules indicate that you should take the disposition in the current year when the asset's disposed. The regs don't say you may, they say you should take the disposition. So if you don't, you're missing out on a benefit that was intended for you to enjoy. The permanent tax savings are the result of the differing tax rates between 1245 recapture, which is at ordinary rates, 1250 recapture at 25%, and capital gains at 20%. Let's look at our previous example where the taxpayer acquired the building in 2010 for $5 million and had those $470,000 in retirements in 2017. If the taxpayer had not taken the retirement deductions in 2017, essentially they would have continued to depreciate that $470,000 until the property is one day sold, and recapture will then be required. So let's say that $370,000 of the basis was 39-year property, and the other $100,000 was 7-year property. The recapture tax on the real property would be $370,000 times 25% added to the $100,000 at 35% for the personal property for a total recapture tax of $127,500. However, as a result of doing the retirement study, the recapture tax goes to zero. There is a capital gain tax on the $470,000, but at 20%, that's only $94,000. So you have a net difference here between the $127,500 and the $94,000, which is your permanent tax savings upon sale of $33,500. Prior to the tangible property regs, removal cost of an old component generally had to be capitalized with the cost of the new component. Now, some of you that have been practicing for a long time may be thinking, that's not the way my taxpayers were doing it, and that's true. In the industry, I think a lot of folks didn't practice that way, but that was the rule. And so under the current law, I think it's recognized the practicality here so that removal costs can be deducted, but only if the taxpayer retires remaining basis from the old component that was replaced. So in our example here, a landlord spends $200,000 on leasehold improvements in each of 3 tenant spaces in year 1. Later on in year 5, a new tenant leases one of those spaces, and as part of the lease requirements, the landlord has to completely demolish the leasehold improvements in that space and rebuild it to the tenant specifications. The total spend was $340,000, and of that, $40,000 was determined to be demolition of the old tenant build-out. In this scenario, the landlord can expense the $40,000 of demolition cost as long as they also deduct the remaining basis in the $200,000 cost of the old build-out that was totally removed. Under prior law, that $40,000 of demolition cost would have been capitalized with the new construction. Now that we've established the importance of determining the remaining depreciable basis of retired assets, let's go over your other options for calculating the remaining basis. The easiest way would be to look at your cost segregation study and see if the item is already broken out for you. If you've had a cost seg study done at least in the last 6 to 7 years, you can pretty well count on having these kind of things broken out if it was a quality study. If you can identify the original basis of the retired component, it's pretty easy from there to calculate the amount of tax depreciation taken to date and the remaining depreciable basis of the component. In addition to using a cost segregation study, the IRS states that another reasonable method could be discounting the cost of a replacement component back to its placed in service year using the producer price index. This approach can only be used for certain restorations. The final regulations do not allow this method to be used for betterments or adaptations. And if you think about it, it only makes sense. For example, if you replaced a standard roof with a much more expensive solar reflective roof, it wouldn't make any sense at all to use the replacement cost of the dissimilar component to derive the historical cost of the old standard roof. Similarly, if you replaced an HVAC system in an office space that had been converted to a restaurant, it wouldn't make any sense to use the more expensive restaurant HVAC as a starting point to derive the historical cost of the office HVAC system. As I mentioned in an earlier slide, KBKG has developed a partial disposition calculator, and I've reproduced that same link here again. Our calculator uses the producer price index to discount the current cost back to the date of original acquisition. The calculator also has the ability to adjust for the condition of the asset, which we'll discuss on the next slide. So simply using the producer price index to take your current cost of the item you replaced back to the date of original acquisition is a good way to estimate the cost historically as if new. However, it stops short of taking into account the fact that an asset can be acquired used and may not be in 100% good condition or like new when acquired. Let's consider this example to help you grasp here what I'm getting at. We have a building that's acquired a few years ago, and now the owner in the current year is spending $200,000 to replace all the aluminum windows. Discounting the current cost of replacement windows back to the time period of 3 years ago using the producer price index is going to result in an estimated historical cost basis of $186,000 for the windows. If the building were brand new when acquired, this would be a reasonable estimate of what those windows were worth as part of that brand new acquisition. However, in our example, we really don't know the actual age of the building or the windows. So one way to adjust for the condition of the windows, I should say there are other ways, but this is an acceptable way, is to assume they had 3 years of remaining life at the time the building was acquired, which is a reasonable assumption because 3 years after we acquired the building, we replaced the windows. We can determine from various estimating sources that the normal life, the expected life of aluminum windows is about 20 years. So in our case, that implies if you replaced it 3 years after you bought it, then it must have had an effective age at the time of acquisition of about 17 years. We can again turn to a number of different depreciation tables to find a condition factor for an asset with a 20-year expected life and a 17-year effective age. And this allows us to conclude an appropriate condition factor would be about 27%, which when applied to the historical cost new of $186,000 lowers that value to $50,220. This is the condition adjusted value of the windows at the time of acquisition, which can then be used to calculate the accumulated tax depreciation and the remaining tax basis of the retired windows. KBKG's partial disposition calculator uses the producer price index to trend the current cost new back to the time of acquisition, and also has depreciation tables and expected lives built in already for the most commonly replaced building components, so it can estimate a condition adjusted replacement cost of the asset at the time of acquisition. It's really a pretty simple tool to use. It only has a handful of variables you have to plug in, and the tool really does all the work. And it's based on the methodology that the IRS suggested. So I would say as last word of caution, though, about using this producer price index discounting method, I strongly encourage reading our article that's referenced at the bottom of this slide about limitations on its applicability. I said earlier that most of my presentation would focus on opportunities that are related to buildings and leasehold improvements. So at this point, you might be surprised to see this slide on materials and supplies. However, for taxpayers that are, say, manufacturing companies, for example, materials and supplies can really be a very significant cost, and so it's worth talking about here in this presentation. Materials and supplies are tangible non-inventory property that's used and consumed in your operations, and they include the following. They include acquired components, which would be the cost of components acquired to maintain, repair, improve tangible property owned, leased, or serviced by you, and that's not acquired as part of a larger item of property. It includes consumables, cost of fuel, lubricants, water, and similar items that are reasonably expected to be consumed in 12 months or less, and beginning when used in operations. Or it would include 12-month property, which is the cost of tangible property that has an economic life of 12 months or less, and beginning when the property is used or consumed in your operations. Or finally, it would include $200 property, cost of tangible property that has an acquisition cost or production cost of $200 or less. It only needs to fit into one of these categories to qualify as a material or supply. As under prior rules, you can deduct the cost of incidental and non-incidental materials and supplies in the following manner. Incidental materials and supplies are incidental of minor or secondary importance, carried on hand without keeping a record of consumption. No beginning and ending inventories are recorded. This would be like your pens, paper, staplers, toner. Then you just deduct the materials and supplies cost in the taxable year in which the amounts are paid or incurred, provided taxable income is clearly reflected. Non-incidental materials and supplies are, the materials and supplies are not incidental, then you deduct the materials and supplies cost in the taxable year in which the materials and supplies are first used or consumed in your operations. So for example, deducting certain expendable spare parts in a trucking business for which records of consumption are kept and inventories are recorded in the taxable year the part is removed from your storage area and installed in one of your trucks. An otherwise deductible material or supply cost could be subject to capitalization, though, under 263A if you use the material or supply to improve property, or under 263 Cap A if you incorporate the material or supply into property you produce or acquire for resale. The application with the de minimis safe harbor, if you elect to use the de minimis safe harbor and any materials supplies also qualify for the safe harbor, you must deduct amounts paid for these materials or supplies under the safe harbor in the taxable year the amounts are paid or incurred. Such amounts are not treated as amounts paid for materials and supplies and may be deducted as business expenses in the taxable year they are paid or incurred. Here's a couple of examples where a taxpayer benefited from the materials and supplies rules. On the left photo, there's a large number of beer kegs. And in the right photo, you see a number of rolling waste bins. In both these examples, the cost of each individual unit was actually less than $200. And in both examples, they weren't tracked in any kind of record-keeping inventory. The taxpayer here wasn't able to take the de minimis safe harbor for these items because it would have caused a material misstatement for GAAP purposes. However, they were able to treat them as materials and supplies and therefore immediately deduct them since there's no book tax conformity requirement for supplies. Under the routine maintenance safe harbor, you are not required to capitalize as an improvement and therefore you can deduct amounts that meet all of the following criteria. Amounts paid for recurring activities that you expect to perform as a result of your use of the property in your trade or business to keep the property in its ordinarily efficient operating condition, and you reasonably expect at the time the property is placed in service to perform the activities more than once during the class life of the unit of property. For building structures and building systems, you must reasonably expect to perform the activities more than once during the 10-year period beginning when placed in service. It'd be pretty sweet if it was the 39-year period. It'd be easy to satisfy, but they say 10-year period for buildings. In our example, you expect to replace escalator handrails once every 5 years, so you've satisfied the routine maintenance safe harbor. And note here, you don't have to actually replace those handrails once every 5 years. You just need to have a reasonable expectation that you would replace them every 5 years. It needs to be reasonable. It doesn't have to actually work out that way. If the amount doesn't meet all the requirements for the routine maintenance safe harbor, you may still deduct the amount if the amount is not for an improvement under the facts and circumstances analysis. In our example, we expect to replace an HVAC unit every 12 years. So it fails the routine maintenance safe harbor. However, it potentially could still pass the bar test and be deducted as a current year repair expense. Here's an example of how the routine maintenance safe harbor benefited one taxpayer in a very significant way. In the left photo, you see one of 3 identical kilns that are used in their business activities. Each kiln is lined with refractory brick, similar to what you see in the photo on the right. This taxpayer would shut down their operations for 1 week in July every year to replace the refractory brick in one of the 3 units. Each year, the taxpayer would replace the brick in one of the 3 units on a rotating basis and at a cost of approximately $300,000. They maintained excellent records showing this was done on a regular basis, and were able to demonstrate reasonable expectation that they would replace the brick more than once during the class life of the property. You're not required to capitalize as an improvement and therefore may be permitted to deduct the cost of work performed on owned or leased buildings, e.g. repairs, maintenance, improvements, or similar costs that fall into the safe harbor election for small taxpayers. The requirement of the safe harbor election for small taxpayers are the following. First of all, average annual gross receipts of $10 million or less, owns or leases a building property with an unadjusted basis of $1 million or less, and the total amount paid during the taxable year for repairs, maintenance, improvements, or similar activities performed on a building property doesn't exceed the lesser of 2% of the unadjusted basis of the eligible building property, or $10,000. You make the election to use the safe harbor for each taxable year in which qualifying amounts are incurred. This election is made by attaching a statement to your income tax return for the taxable year. An annual election is not a change in method of accounting, so therefore you shouldn't file a Form 3115 for an application for change in accounting method in order to make this election or to stop applying the safe harbor in a subsequent year. Take note of our KBKG tax planning idea. A taxpayer could be in a situation where a cost segregation study might actually reduce the real property basis in building enough to make them eligible for the safe harbor for small taxpayers election. In our example here, the taxpayer had building basis of $1.3 million prior to the cost seg study. After reclassifying $400,000 to 5 and 15-year recovery periods, the remaining 39-year basis is only $900,000, just below the $1 million threshold. prior to the tangible property regulations, repairs made to a building in conjunction with a larger rehab project had to be capitalized. This was referred to as the plan of rehabilitation doctrine. I heard a lot about this in the early part of my career, and unless you've been around a long time, you may never have heard of it, or you may have long forgotten it. Well, with the new regs, those repair and maintenance type costs weren't incurred because of the improvement. They can be expensed in the current year. So the question becomes, was the expense necessary to complete the improvement or not? Here's an example. If a taxpayer spends $500,000 to rewire his building and incurs $30,000 of cost to repair drywall that was damaged in the process of those electrical upgrades, the total cost of $530,000 must be capitalized. However, if the $30,000 cost of drywall repairs was totally unrelated to the electrical work, it could potentially be expensed as a repair, assuming it meets all the other criteria for such treatment. Well, several of the prior slides have referenced the de minimis safe harbor election. Under the final tangible property regulations, you can elect to apply a de minimis safe harbor to amounts paid to acquire or produce tangible property to the extent such amounts are deducted by you for financial accounting purposes or in keeping your books and records. If you have an applicable financial statement, you may use this safe harbor to deduct amounts paid for tangible property up to $5,000 per invoice or per item. If you don't have an applicable financial statement, you may use the safe harbor to deduct amounts up to $2,500 per invoice or per item. These limitations are for purposes of determining whether particular expenses qualify under the safe harbor. They're not intended as a ceiling on the amount you can deduct as a business expense under the code. The de minimis safe harbor election does not include amounts paid for inventory and land. Additionally, it doesn't apply to rotable, temporary, and standby emergency spare parts. And the taxpayer elects to capitalize and depreciate under 162.3D. It also doesn't apply to rotable and temporary spare parts that the taxpayer accounts for under the optional method of accounting under 162.3E. Neither the code nor the prior regulations included a de minimis safe harbor exception to capitalization. You were required to determine whether each expenditure for tangible property, regardless amount, was required to be capitalized. This de minimis safe harbor election eliminates the burden of determining whether every small dollar expenditure for the acquisition or production of property is properly deductible or capitalizable. If you elect to use the de minimis safe harbor, you do not have to capitalize the cost of qualifying de minimis acquisitions or improvements. However, de minimis amounts you pay for tangible property may be subject to capitalization under 263 Cap A if the amounts include the direct or allocable indirect cost of other property you produced or acquired for resale. For example, you must capitalize all the direct and allocable indirect cost of constructing a new building. An applicable financial statement includes a financial statement required to be filed with the SEC, as well as other types of certified audited financial statements accompanied by a CPA report, including a financial statement provided for a loan, reporting to shareholders, or for other non-tax purposes. An applicable financial statement also includes a financial statement required to be provided to the federal or state government or agency other than the IRS or the SEC. After the final regs came out in 2013, the National Retail Federation lobbied for recognition of the regular remodels performed on retail and restaurant properties to keep them competitive and up to date. Their lobby was very effective. The result is Revenue Procedure 2015-56, which provides a safe harbor for these taxpayers that meet the defined criteria. Generally, the safe harbor benefits those who are enhancing the physical appearance and layout of their buildings in order to maintain an attractive environment for their customers. The safe harbor allows 75% of qualified amounts to be deducted as a current year expense. The remaining 25% is then capitalized. In addition to the obvious tax benefits, it also relieves some of the burdens of evaluating the unit of property and then tracking assets on the depreciation schedule. To qualify for the retail restaurant safe harbor, the taxpayer must have an applicable financial statement. If the taxpayer is in the retail business, they must be in the trade of selling merchandise, including goods to resellers such as a warehouse club and home improvement stores. Certain types of retail activities are excluded, including automotive dealers, other motor vehicle dealers, gas stations, manufactured home dealers, and non-store retailers. If the taxpayer is a restaurant business, they must be in the trade or business of preparing and selling meals, snacks, or beverages to customer order for immediate on-premises and/or off-premises consumption. However, certain types of restaurant activities are excluded, including hotels and motels and others, the rather long list here that you see on the slide. The idea here is their primary business activity should be that of a restaurant instead of these other types of activities that are listed. This slide includes a list of what is not considered qualified property that's eligible for this special safe harbor. It doesn't include 1245 property, intangibles, land, initial acquisition costs, initial build-out costs, those activities that ameliorate a pre-existing condition, material additions, restoration where casualty loss was claimed, and so on. All of these items must first be removed from the total cost before calculating the 75% that is deducted as a current year expense here. So from a cost segregation perspective, we see this a lot, and I would notably point out that the Section 1245 is supposed to be excluded, and you would want to break out your 5-year property first before applying the 75%. So it's to their advantage to identify that 5-year property, the tangible personal property, separately, and leave only the non-residential real property into the pool, that 25% of which has to be capitalized. So by pulling out these other items, you're reducing the amount that's going to be capitalized. The analysis is probably not as simple as you might have thought when we started talking about this retail restaurant safe harbor 2 slides ago. It got a little complex, but for retail and restaurant taxpayers, it's potentially a very, very valuable tool that should be given careful consideration. I mentioned earlier, I brought up the audit techniques guide related to the capitalization of tangible property, that it's out there. And in March of 2012, IRS examiners were instructed in an LB&I directive to discontinue examining issues involving whether costs incurred to maintain, replace, or improve tangible property must be capitalized under 263 small a, and any correlated issues involving the disposition of structural components of a building or dispositions of tangible depreciable assets. Well, with the release of the final tangible property regulations in 2013, and then the disposition regulations in 2014, and then the audit techniques guide in 2016, I would say the service is preparing itself for substantial audits related to the tangible property regulations. Who knows where it is as far as a priority for them? They've certainly got their hands full with challenges they face with restrictions on the number and resources that they have to work with, but the plan is in place for them to audit and follow through on how taxpayers are using the tangible property regulations, the disposition regulations. So I encourage you to take a look at that document. As we near the end of our presentation, here's a list of the most common accounting method changes that we see in our work with clients. Change number 7 is used to correct changes to depreciation in a prior tax year due to a cost segregation analysis or an individual asset reclassification. Change number 205 is used to recognize the disposition of a building or structural component for separately stated assets such as tenant improvements or roof. Change number 196 was used for recognizing late partial disposition in prior tax years. Notice I said was, and as previously explained, this change expired after 2014. But you still have the opportunity to recognize partial dispositions as long as you do it in conjunction with a timely filed tax return. Very important to remember that. Change number 21 is used for recognizing prior year's removal costs as a deductible expense. And change number 184 is used for recognizing capitalized costs that could have been treated as a repair expense. How can we help? Well, prior to the tangible property regulations, we would have said, let us help you with any missed cost segregation opportunities. These are often discovered during a comprehensive fixed asset review. Over the years, we've become very good at also identifying opportunities to take advantage of retirements and dispositions. And when scrubbing through a fixed asset list, we usually turn up lots of assets that have been misclassified. We also see opportunities to expense costs that were previously capitalized. And we see assets that were eligible for bonus depreciation, where taxpayers didn't intend to elect out, but just failed to claim the bonus. We can help prepare the 3115s or help CPAs prepare them for their clients. Perhaps most beneficial is our proprietary software that allows us to quickly identify these missed opportunities in a comprehensive fixed asset review. We have several software solutions that may be of use to you with respect to the topics that we covered today. They're all available at the web link listed on this slide. If you've never been to our solutions page before, you'll need to create a profile with a username and password in order to log in. There's no charge to do that. It's just you need to create your profile before you can examine all these tools. Once you've logged in to our solutions dashboard, you'll see the tools listed on this slide. You'll notice that the partial disposition calculator that I referred to earlier, for example, is there. And I should point out that we have webinars that go into detail on how to use our software tools. So if you have questions or need help gaining access, feel free to reach out to me. We want these tools to be available to you and encourage your use of them, and welcome the questions.